that after studying this module, we shall be able to first know the meaning of large projects, secondly, understand the risk involved in large projects, thirdly, evaluate the risk in large projects using risk techniques, and fourthly, identify the risk associated with large projects. Risk is always present in any kind of project. The success of a project depends upon how a project performs in future, and future being always uncertain, there is risk. Any project requires a lot of investment, and the larger the project, the more the investment. These investments are made in expectation of future benefits, and there is always a risk whether the expectation will be fulfilled or it will be frustrated. Thus, we may say that large projects are very risky as the losses can be very high if expectations are not fulfilled. If we take a simple example in the real life, Shell company, after doing lot of digging in search of deposits, gave up and thinking that there are no deposits underneath. They sold the site to Cairns company. The site was in Gujarat, and the geologists of Cairns company, who were positive about the fact that the basin contains reserves, purchased the site, and they also found the reserves. It was a huge gain to the Cairns company and simultaneously a huge loss to the Shell company. This kind of risk in business always prevails, and if the business are large, the investment would definitely be large, and so the losses will also be higher, then therefore the risk is also high. Now we move on to risk in large projects. In the module titled Techniques of Risk Analysis, we have discussed various methods of risk calculation analysis. Some of the techniques of risk analysis is standard deviation, scenario analysis, sensitivity analysis, and Monte Carlo analysis. Standard deviation calculates both the upside as well as downside risk, whereas as an investor, it should not matter if the movement is towards positive side. Therefore, another measure of risk is the Sortino ratio, which measures only the downside risk. Some of the techniques were simple, like calculation of range, while some others were complicated, mathematical or computerized models like the Monte Carlo simulation, the sensitivity analysis, the scenario analysis, or decision tree approach. No matter what the method of calculation be, it is no denial that the larger the project, the more significant and of greater magnitude will be the impact if these are calculated for large projects. For example, let the standard deviation in earnings be 5%. Now, if earnings of a small project is just rupees 1 lakh, the impact will be rupees 5,000 only. But if the project has an earning of rupees 500 crore, imagine the impact of a 5% deviation. So, if the internal rate of return of a project whose investment is rupees 5 lakh fluctuates by 1% and comes down to 10% from an earlier figure of 11%, there is loss and risk. But if the same fluctuation is faced by a project with initial investment of rupees $50,000 million, just imagine the kind of impact. It will definitely be very large. Why it is that large projects have higher risk? What causes large projects to be more susceptible to even a small change? Let us try to figure out some of the causes and list them down one by one. First, operations expanding more than one nation. Large projects generally have operations expanding in more than one country. The operations of a large project expand in many countries, and therefore they face more risk than a medium or a small project. With operations extending all over the globe, the projects face the country-specific risk and exchange rate fluctuation risk. If we remember that when the rate of dollar fell against Indian rupee in the international market, the Indian software companies which had huge business in USA suffered losses as the value of their receivables through export of software came down. These companies later on diversified their operations in other countries as well to avoid the impact of specific countries' currency risk. The second is large operations. Large projects means that there are more people working in the organization and there are more activities to be accomplished. Whenever there are many people working in the organization, they need to work as a team. More clear communication and understanding within the team is required. There will be many plans to be executed and many activities should be interrelated. The amount of contingencies that occur will also be more. When the people involved are more, the number of activities is more, the customer base is higher, obviously the uncertainties associated with them will also be higher, and therefore more contingencies can occur. One single person cannot identify the possibilities, contingencies, and neither one single person will have the capacity to deal with the event. Therefore, various contingencies should be identified and their impact and the manner they should be dealt with should be provided in advance, and therefore there has to be someone who could be made accountable for the outcomes of the contingencies and risk. More coordination is required to make the project successful, and if the coordination fails, the project will also fail. So there is the risk of failure of coordination. The third type of risk is large production capacity. When large projects are installed, the production facilities are also large and everything is on a large scale. More capital is required. Risk is also on the higher side. The two components together, that is more capital requirement and higher risk, causes the cost of capital to go up, thereby increasing the business and financial risk. All days are not the same. So in times of recession, when sometimes there is no sale, all operations come to a standstill. In such circumstances, it is difficult to sustain the cost of large projects. It will be difficult for the large projects to bear continuing losses, and even the shutdown cost will be higher in cases of large projects. If business stops due to the strike of the workers, the large project definitely suffer more. The large workforce in large projects also has stronger negotiating power, and they can press the management to bow down to their demands. The industrial laws are also strictly applicable, and if laws are flouted, they gather the attention of media sooner than otherwise. This fact can be exploited by the workmen to get their ends meet. Then we have government policies regarding large projects. Large projects have the interest of the government as they are very important for the growth and development of the nation. Government grants subsidies also, and in order to promote the development of certain backward areas. It also offers a lot of tax incentives and tax holiday periods. But when government offers these benefits, it also imposes certain restrictions and conditions. There is always this risk, and if the conditions are not followed, the subsidies and grants may have to be given back. When projects are installed, considering the tax incentives offered by the government, there is no complete freedom of location and other aspects, and therefore it is likely some benefits like nearness to the customer base or location of the plant near to the supply of raw material is foregone in lieu of tax benefits. Besides, there can always be changes in the government policies, and they will have significant impact on large scale projects. Small projects are generally not so harshly affected by changes in government policy. In India, government is particularly more concerned and in favor of developing the small scale sector. The government is also protective of all the small scale sector and encourages small and cottage industries. Large projects are often automated and require fewer workforces. In a country like India, which is facing the problem of population and unemployment, it is quite obvious that the government will make plans and policies which are more conducive to small scale sector and rather than large projects. Thus, the risk from the government policies always looms large over the large projects, though nowadays it is not as strict as regulated like it once used to be in pre-liberalization period. Then we have the risk associated with outsourcing risk. Large projects have so much to handle and in so many countries across the globe that it might have to outsource some of its processes and operations. The level of quantity that the organization look forward to and the level of standards it want to maintain in the industry may not match the standards of the outsourcing partners. And even if some of them are quality conscious, not all outsourcing work can be of same standards, and therefore some compromises may be required to be made, and this may create the risk of tarnishing the reputation of the organization. The next risk arises due to lack of proper infrastructure. Large projects need good infrastructure to be successful. The output of large project is required to reach the markets, and that too quickly. Their products are exported and they may also import material from abroad. The large machines require a lot of power and fuel. All these things are possible if and only if the country has the proper infrastructure to support these projects. There should be good roads, ports and airports. The communication system and network should be good and maintained. There should be enough generation of and distribution of electricity. If these things do not fall in place, the industries and projects suffer, and obviously the risk is more if projects are large. Sometimes investment in infrastructure will be required to be done by the large projects without yielding much return on such investment. The next risk arises due to risk of obsolescence. Whatever the industry one may be in, there is always a risk of obsolescence. And due to new technology and innovation, and it is very much possible that the output of the project becomes obsolete. If the output of the large project become outdated and a substitute to replace them emerges in the market, the entire project will have to make necessary changes, or the entire project might be required to be scrapped. This will be a huge loss, especially in the case of new and large project. This is a big risk, but efforts can be made to remove this risk by keeping oneself abreast with the latest technology and changes in the market, and keeping a plan that is flexible to adjust to the changes in the industry. Despite that, it cannot be predicted about the future as to what technology may come up, and therefore the fear of obsolescence poses very high risk to the large projects. It is always more costly and cumbersome to bring down or wind up a large project. Then we have risk associated due to risk of arranging finance. Large projects require more finance, and sometimes it is not possible for a single financial institution to provide for entire finance, or it does not want to take the entire risk. Large projects may have to opt for syndication of loans, and therefore there will be more covenants and restrictions in the loan agreements. There is always a risk if so many conditions imposed by loan agreements are defaulted. Besides, large projects are generally burdened with interest and principal repayments, and there is always a financial risk that if this cash cycle is not maintained and if any default is made, there can be serious repercussions. The tenure of loan is also large in case of large projects. The next risk associated with risk of right manpower at the helm. Handling of large project is not a very easy task, and it requires the skills, experience, expertise and grit, which is very rare. Leadership issues are always a very big problem, and finding the right successor which is acceptable to such a large number of people working on the project is a big risk altogether. One can witness a number of cases and examples where large empires and big business houses have failed due to the problem of finding the right successor. Now we move on to evaluating risk in large projects. Understanding and identifying risk alone does not serve the purpose unless the risks are properly evaluated, and some tools or techniques or methods of hedging those risks are not provided. It will be useless. Small projects generally have a very concise picture of the risk, and the impact of the risk can also be evaluated. Large projects have high risk and it is difficult to assess the risk, but certain techniques can be used to hedge these risks. If it is not possible to avoid the risk and there is not enough capacity to bear the risk, then this risk should be transferred or shared. Getting things insured is a good way of sharing the risk at a small price in the form of insurance premium. Some techniques of risk analysis that are generally applicable to the large projects are discussed as under. Although these techniques have been discussed in detail in the module number 35 on risk analysis, but their brief mention together with relevance in large project is dealt here. We start with scenario analysis. When large projects are taken up, there are many variables which simultaneously impact the performance and risk of a project. If a thorough analysis is done, taking all possible scenarios as far as possible and looking at the impact of all those variables on profit, it will be a good way of judging the riskiness of the large project. Under this method of risk analysis, all possible permutations and combinations of different variables are considered. The second analysis is sensitivity analysis. This method of risk analysis measures the percentage impact on the profile of the project for a small change in any one variable. While doing sensitivity analysis, only one variable is altered at a given point of time, keeping all other variables constant. In this way, it can be detected as well as measured that which is the factor that really is crucial to the project and what is the level of its impact. Which factor contributes maximum change in profit for a small change in its value can be determined. After that, all efforts can be made to remove or at least reduce the impact of these variables. Then we have Monte Carlo simulation. This is a more realistic technique of risk analysis. The merit criteria is judged on the basis of many variables. Some variables are such over which the decision maker has control, but there are some variables which are stochastic in nature. This is very good method of risk analysis as this method uses random numbers and simulates the real situation for many number of times and the outcome is then measured. After that, the outer boundary of the all-run test is taken up and it is expected that the real outcome will fall within the already laid down range. This way, the maximum risk in the project is already established and a more rational decision can be taken which can reduce, avoid or share the risk. Then we have decision tree analysis. This technique of risk analysis helps in taking those decisions which are sequential in nature. A systematic decision tree is constructed gradually, guiding the investor to the right path. The investor starts with one or more options to begin with and he has no control over the outcome. The first step is to construct a decision tree of the various alternatives in a sequential manner, one after the other. The second step would be to assign the probabilities to the various outcomes. The monetary benefits attached at each outcome are also determined. The expected value at each mode of decision tree is worked out and the most favorable decision is arrived at. There can be more than 2 stages in the decision tree. This method is very relevant for large projects as they are faced with the problem of more than one alternative courses of action. Then we have net present value. This method can also be utilized for measuring risk. Under this technique of risk analysis, the future cash flows are discounted at an appropriate rate of interest which is adjusted for risk. The higher the risk perceived by the investor, the more shall be the discounted rate. So, the large projects can be discounted using 100 base point, that is 1% is equal to 100 basis points higher discount rate to evaluate the project keeping all other factors constant. Then we have subjective risk analysis. This method of risk analysis is very useful, especially in large projects, as large projects have so much to be looked into that the judgment of an experienced person can serve as the best tool to be analyzed the risk in large projects. Now we move on to the summary of what we have discussed so far. The very first we have discussed the risk in large project is always more than other project and there are obvious reasons for the same. Second, we have discussed large projects have operations in more than one country. Then we have discussed they are more exposed to changes in government policies and any fluctuations in the exchange rates or interest rates. Then we have discussed government also imposes restrictions and conditions on large projects more in comparison to small undertakings. Then we have seen that large projects are more influenced by recessionary conditions. Large projects are also subjected to higher tax rates. They have more workers and face more labor problems. Then we have seen they are required to manage better teamwork and arrange for finance. The risk in large projects can be measured by using any of the risk measurement technique and in particular the scenario analysis, sensitivity analysis, Monte Carlo simulation, decision tree approach and the net present value criteria. They are some good means especially in large projects to measure the risk analysis. Besides the above methods, subjective risk analysis serves the purpose of analyzing the risk very well.